Welcome back, BAccSc, CTA, and SAICA students. Let's jump right into this definitive masterclass on Module 6, Part 1. Today, we're focusing entirely on the General Deduction Formula, or the GDF, and exactly where and how you're going to score those absolutely crucial exam marks. We're breaking down the highly examinable legal principles under the South African Income Tax Act, zooming in on carrying on a trade, and the first three elements of the GDF.
We've got a tight roadmap for today's explainer. We'll start with the foundational tax framework, tackle the carrying on a trade prerequisite, map out the GDF, and dive deep into those first three elements. Then we'll wrap it up with a foolproof exam technique and a comprehensive worked example. First up, the foundation, our introduction and tax framework. Before we can even begin looking at individual deductions, we have to know exactly where they fit into the grand scheme of the Income Tax Act, and that's for both companies and natural persons. So you start your calculation with gross income, subtract your exempt income, and that yields your income as defined. From there, you subtract your deductions. Now, notice how we break deductions into two distinct categories. You've got the General Deduction Formula, which is Section 11A read with Section 23G, and then you have these specific deductions found in the remainder of Sections 11 through 19. If a specific expense doesn't meet a specific deduction rule, your default fallback is always going to be the GDF. Okay, before we go any further, I want to give you an absolute exam gem. Seriously, never, ever forget to state that the burden of proving an amount is deductible rests squarely on the taxpayer. That's dictated by Section 102 of the Tax Administration Act. In a test scenario, simply writing down that the onus of proof is on the taxpayer, per Section 102, is often an easy, guaranteed mark. Do not leave that mark on the table. Moving on to the gateway of it all, carrying on a trade. Before any Section 11A deduction can even be considered, you've got to pass the gateway test. The taxpayer must be carrying on a trade. The definition under Section 11 of the Act is incredibly broad. When you're writing your exam, you absolutely must reference the landmark case of Burgess v. CIR. This is the case that established that the definition of trade should be given a very wide interpretation. It encompasses virtually every profitable activity. I mean, even a single isolated venture can constitute a trade under this definition. When you're evaluating a scenario, you need to look for a few specific characteristics. Is there a continuity of activities? Is there a profit motive? And most importantly, is there an active step? Now, what if the entity is a nonprofit? Well, in that case, you look for a commercial or business benefit instead of a pure profit motive. But here's the catch, and it trips up so many students. Passive income earners, like folks who are just collecting interest, dividends, or annuities, are excluded from carrying on a trade because they aren't taking any active steps. The exception, of course, is if the taxpayer is actually a moneylender or a share dealer. The CSARS v. Scribante construction case is a perfect illustration of this concept. Normally, just earning interest is entirely passive. But in Scribante, the taxpayer borrowed money and actively relent it at a higher, increased interest rate to generate a profit. The court ruled that this active step completely transformed passive interest earning into the active carrying on of a trade. So always look for that active intervention in your exam scenarios.
All right, let's get into the main event, the GDF overview and its 6 elements. The General Deduction Formula is essentially a strict legal checklist, and every single box must be ticked. The GDF is made up of a positive test and a negative test. You must meet all 5 positive elements of Section 11A. Those are expenditure and losses actually incurred during the year of assessment in the production of income and not of a capital nature. And then finally, you must survive the negative test of Section 23G, which strictly prohibits deductions unless they are laid out for the purposes of trade. Keep in mind Section 23G contains those magic words, to the extent, which legally allows you to apportion an expense between trade and non-trade purposes. Let's zoom in and break down the first 3 elements of that checklist. Okay, let's look at the granular case law you need to secure your application marks. Element 1 requires there to be expenditure and losses. But what does that actually mean legally? Well, expenditure requires a diminution or a movement of assets. You've got to remember the Labatt case, which proved that a company merely issuing its own shares doesn't actually reduce its assets. Therefore, issuing shares does not qualify as expenditure. And then we have the Joffy & Co. case, which beautifully distinguishes the two terms. Expenditure is a voluntary payment of money, whereas a loss is an involuntary deprivation. Moving right along to element 2, actually incurred. Guys, this is a massive area for examiners. Notice the law explicitly says actually incurred, not necessarily incurred. That means even if a business is run terribly and incurs expenses that honestly weren't strictly necessary, As long as there is an unconditional legal liability, the expense is actually incurred and therefore deductible. Plus, actual cash payment is not required. A binding, unconditional legal obligation to pay is all it takes to tick this box. Let's look at the specific case law that defines this unconditional legal liability. Edgar Storrs confirms the absolute need for that unconditional obligation. Nationale Pairs shows us that without a definite liability, nothing is incurred. But the real heavy hitter here is Golden Dumps. Golden Dumps dictates that if you genuinely dispute a claim or an invoice, your liability immediately becomes conditional. And because it's conditional, it completely destroys the actually incurred requirement for that specific year of assessment. Also, keep in mind that provisions for anticipated future losses are entirely prohibited by Section 23E, simply because they haven't actually been incurred yet. So, what happens with unquantified amounts? Let's look at an original scenario dealing with Section 24M. If you acquire an asset, like trading stock, and part of the purchase price is unquantifiable at year-end, Section 24M deems that unquantified portion as not incurred. In our scenario, the upfront 50,000 Rand is easily quantifiable and actually incurred in 2026. But that 5% of future turnover, we don't know what that is yet, so it is deemed not incurred in 2026. It only becomes actually incurred in 2027 when the turnover is finally known and that 20,000 Rand obligation becomes a quantifiable reality. Element 3 is strictly chronological. During the year of assessment, the sub-Nigel case dictates that expenses must stay within the exact tax year they are actually incurred. You can't creatively carry expenditure back to previous years, and you can't push it forward to future years to manipulate your taxable income. The only major exception to this strict timing is Section 23H, which deals with prepaid expenditure, but we'll tackle that in a future explainer. Now, how do we actually secure those marks? Let's talk exam technique. You know the theory now, but how do you translate this knowledge into high-scoring exam answers under immense time pressure? This sequence is your ultimate exam technique. When faced with a GDF question, follow these exact steps chronologically to ensure you harvest every possible mark from the rubric. Step 1, state that carrying on a trade is a prerequisite. Step 2, list out all 6 elements of the GDF. Step 3, pinpoint exactly which element is the issue in the scenario. Step 4, hit them with the Section 102 TAA onus of proof. Step 5, bring in your case law. And finally, Step 6, apply that case law directly to the facts of the scenario and conclude. Let's put it all together in an original, comprehensive masterclass example. Imagine this scenario. An active retail business receives a delivery of new trading stock right at the very end of their 2026 tax year. The supplier slaps them with an invoice for 100,000 Rand. However, the business spots defects in the stock, so they genuinely dispute 40,000 Rand of that invoice before year-end. They do, however, accept liability for the remaining 60% and pay that 60,000 Rand immediately. Now, putting on your tax practitioner hat, how much can they actually deduct in 2026? Let's apply our framework step by step. Let's put that exam technique into action. First up, trade. The taxpayer is an active retailer satisfying Section 1.1 and the wide interpretation from Burgess. Second, onus. You simply state Section 102 of the TAA. Third, expenditure. The purchase of stock is a voluntary disbursement which satisfies Lobit. But here's the absolute crux of the problem, actually incurred. Because that 40,000 Rand is genuinely disputed, the Golden Dumps principle applies. That portion of the liability is conditional and therefore not actually incurred. Finally, the year of assessment. Under sub-Nigel, only the unconditional, undisputed 60,000 Rand is incurred and deductible in 2026. That disputed 40,000, it's completely deferred until the year the dispute is finally resolved. Here's a final thought to leave you with today. We just saw exactly how disputing a defective invoice legally blocks a massive portion of your tax deduction for the current year. But think about the commercial reality of that for a second. If your deduction drops, your taxable income stays higher, and your actual tax bill for the year increases. So if disputing an invoice legally delays your tax relief, is your business's cash flow actually prepared for that sudden tax hit? Keep building that exam framework, understand the commercial impact behind the law, and I will see you in the next explainer.